We are looking at the new week opening gap for this given week. Okay, so here is the settlement price on Friday. We are seeing the responses off of that new week opening gap here. We trade down to the low. We have really nice relative equal highs in place now going into the opening. We've attacked the relative equal lows here. Let's take a quick look at the regular trading hours. Never be in a rush. Don't feel like you're missing anything. So we have this price here. That is your opening range gap high. We are now trading and formulating the opening range. So that's your range gap. We came back up almost 3/4 of the way. Just fell short of that there. So I'm measuring the opening price to where we closed the previous session on regular trading hours. We have relative equal highs, and we didn't quite completely close that in. It's the first few minutes of trading, so I'm watching to see if we have any interest in doing that. We have a little bit of sell side resting below these relative equal lows here. It's a swing low. So don't look at this area here as there's no low there to mark with this one. It is this one and this one. So you use the lowest one. You're going to take that. So it came back up, hit the new week opening gap low here. You can see the response off the lower quadrant on the opening range gap, which is shaded here in pink. Just bang the bottom of the opening range gap low again. And the buy side is here. Sell side is down here. If it wants to overshoot that, how far can it go below here? You can touch the new day opening gap on August 16th. That's your range for liquidity on both extremes. You have buy side and sell side. So far, we have respected the opening range, failed to get at the 3/4 or upper quadrant level, consequent correction of it. And do we want to sweep down to engage this liquidity here, and re-tap into that new day opening gap on the 16th? And then should it do that, I would expect it to try to make some kind of an attempt, but to give some kind of technical indication that it may want to be interested in going up here. So that means I'm kind of forecasting some idea technically that would potentially form, say, a very small short-term breaker, shift in market structure, some kind of a fair value gap that you can come back in, tap into. And if it gives that type of technical formation after trading down into here, then I'd be interested in see, does it start building all of those same things that we look for in all the price run from here all the way up, using every reference point there carried over here, use it like a footing to climb higher to make an attempt to get up in here. I'm not calling that as a bias. That's something I'm interested in to see if it'll do it. That's not me saying I'm only waiting to do that, because right now I'm waiting to see, does it want to trade down here? So there's the reach below the sell side liquidity. You want to screenshot it. How far can it trade below the sell side liquidity? Initially, it can touch the new day opening gap here, as we just saw here. You want to screenshot that. So I want to show you inside of this opening range gap, what makes it the opening range gap. We have 930. That's the opening price. That's what's being anchored to. And the high is where we stop trading regular trading hour. Regular session trading settlement is 4:15 p.m. Eastern time. So it's very important you understand what these levels and what I'm referring to. This is the opening range gap, the difference between where we settle at 4:15 p.m. Eastern time and where we start trading regular trading hours. That means we start trading at 9:30, we round up. Now we overshot the new day opening gap, so we want to see, does it want to make an attempt to get in here, find some footing inside of these wicks? Why? Because there's consequent correction in that. And then maybe wick out of that, come back down and tap the new day opening gap high again and start making some structure to maybe return back into the new week opening gap low and get back in potentially into this opening range gap. I'm not calling that. I'm looking for reasons to hunt a setup should that form. I've already outlined where it was going to reach to. You're looking for reasons to justify why the market may do a certain run here or there, or what is nice rather, is that we've already had the sell-off down into the liquidity we were looking for, and we have these relative equal highs that are just sitting there. Now, who's made money so far this morning? Shorts. So the initial opening range is 30 minutes long. So you're best served by not taking any entries in that first 30 minutes when your experience level is nil, when you don't know what you're looking for, when you don't know how to trade, you don't know how to read price action, to sit still for the first 30 minutes. Number one, it teaches you discipline, it teaches you patience, and you're also going to filter out a lot of the fake price setups that you're probably going to be impulsively chasing. How fast we came right back up in the opening range gap. We're inside of the opening range gap. So now what we've done is we've gone just above this high here. We've now delivered buy side a little bit more. Buy side still is inefficient until we touch the high of that. Now it can touch the new week opening gap low and wick just outside of it because we have a little bit of inefficiency. See that candle's high right there and where we are here. So it can go back down into this portion. The wick can go below this new week opening gap and still maintain the structure that's conducive for it to go back up here and challenge that buy side liquidity, that everybody feels safe right now. Would you feel safe if your stop was there and you're short? So we came all the way back down into this area here with this wick and closing price. This area here should not close in now because we've already went back into the opening range gap. I'd like to see a close above the consequent encroachment of that, and then next candle come down, fail to touch consequent encroachment, and then springboard into upper quadrant of the new week opening gap high and that mid level between halfway and here, which would be upper quadrant, and then build some momentum to try to get into that buy side. All right, so we were able to get to the high of the opening range gap. One more time, tapping in here. Look back where we are in this. No actual fair value gap. That small little separation right there. That's the only thing that my eye jumps to, and that's about midpoint of that down close candle. So in my mind, can it touch that again? It could. I'd rather it didn't. It needs to get up into and use this little area in here as a footing. If not, run right on them and take the buy side out. All right, so see the volume imbalance right here? With what we already have in price, when we came down here, whipped below the new day opening gap from August 16th, came back, climbed all the way back up into the opening range gap, which is shaded in pink, and found its way to the high end of it. This to me is a little porous because we had these two candles in here. Even though the opening of this candle and this close of this candle are essentially the same, this sputtering, this like little bit of pause without any bodies forming, kind of like in my mind thinks it has to deliver a couple times in that area again. And you can see we had it here. We had a buy side here. We opened, traded back down, and we opened, traded right one more time up. So we're getting that return back into the opening range. So that's what I'm saying. We have to get through this area here. So we're spending a little bit more time in the opening range than I would have liked. So if it's going to run for that buy side, it would need to giddy up and go and not do a close below the midpoint of that wick right here. Can it come down and tap that and come all the way back up and run over top? Sure it can. But I wouldn't personally want to be interested in seeing anything on a close below the midpoint of that. I'd like to see this stay open. If it comes down and hits it and rejects, that's another entirely supporting thing that would be in the delivery, but still I wouldn't want to see it. In other words, say I was in a trade, I would not want to see it come back down in here. I'd like to see it support the wick here with no close below. At the end of the week, when you get to Friday, when it's no longer trading or the weekend, go back and look at your 1 minute charts and you'll see a lot of overlapping price delivery, back and forth, back and forth. That's usually what you get on the week that Jackson Hole Symposium unfolds. There is no other time of the year or any kind of other event that I've noticed that it has that characteristic. So see how we're back and forth? Everything's overlapping the previous short-term run. And if you're expecting, that real nice one-directional price runs during the week of Jackson Hole is going to frustrate you because this is what I've encountered. Now, is it every single week that it does that when it's Jackson Hole? No. When can you expect seek and destroy Jackson Hole? But it can be done in a manner where you don't see it coming. You don't really think it's there until it's actually stopped you out several times. And the worst thing you can do is overtrade on this week. So know what you're looking for. What's the easiest low-hanging fruit objective? Say, for instance, you felt strongly that this turn down here was something to be noteworthy. And we thought that the opening range gap could be a nice draw. When we ran up into it here, you created that short-term high and didn't completely close into the top of it. When it trades back down, as soon as it crossed it right there, that would have been a partial. And I was pulling your attention here. It needed to get through that. It went right up in that area, stagnated, and then rolled down 3/4 of the opening range gap, lower quadrant of the opening range gap, and failure to get to the new week opening gap low or touch the opening range gap and displacement to the downside. So watch this wick in here. This is the lowest one. So far we cleared the rejection block, which is the lowest down close candle in the swing. Here, note that volume imbalance right there. See where the bodies have closed at? Right inside that volume imbalance. That's the stuff I like to look for. The wicks are allowed to do the damage. The wicks are going to reach outside of the levels that you want to see them stay within. And that's one of the things you're going to have to get comfortable with. The first time I showed him a fair value gap, he thought that by me describing it, it should go right in there. Don't go outside the lines of the low and the high of it. Just go right into the middle of it, completely overlap it perfectly, and then move to the higher low that we were aiming for as a draw if we're trying to use it for a long. And as soon as it would color outside the lowest boundary of it, the body of the candle is still active because it hasn't closed yet. But it's just outside of it. And he's like, okay, well, Dad, shouldn't we get out of this right now? Is this not going to go up because look what it went outside? No, that's the part you have to submit to. Like, you have to watch these things. And when you see that it's just forming the wick, that's all it's doing. And before it can become a wick, it has to be a bold-faced candle at the level that makes the low of the wick or the high of the wick. So you can't appreciate that unless you sit here and watch very low time frame charts, because you get lots of examples of it. Look at the reaction off that volume bounce I went into. And look how the body's closed right at it. See that? So here at the opening range, gap, high again. So now we don't want to see the midpoint of that. We don't want to see that breached, because we've been here multiple times now. No close below. It can touch it. It's better if we don't go down and touch it at all. And okay, we touch it now, it needs to be responsive. We don't want to see it come back down below the new week opening gap low, which is this level here, on a closing basis. We don't want that. All of this, while the candle's open, completely normal. Nothing to be worried about, nothing to be concerned about. It's exactly what you need to see. If a wick's going to form, you got to give the candlestick the opportunity to go down there or go up there to form the wick. If you try to be perfect and say that it can't do this and can't do that, it's going to humble you fast and it's going to make you frustrated. There's the wick formation. We opened, touched one more time the consequent encroachment of that opening range gap. Delivery here's now it needs to speed up right above here. Here is the buy stops that are resting above the relative equal highs. And as I'm pointing out things, what you should be doing as a viewer is when I mention something, okay, for instance, when I talked about how we could go down here and go into the new day opening gap on August 16th, you can trade down into that below these lows over here. Well, if it's going below here, how far can it go? Into that new day opening gap. But then you have this swing low here. So we have sell side that can tap into an old new day opening gap. What did I teach you about that? That we can see them, trade through them. And then you want to see how they behave once it does it. We're not always expecting a stop and turn, no further run through, nothing that's demanding precision like that. You can frame entries with precision elements, but we're looking for a bias. We're looking for some kind of like a sentiment to shift in the marketplace, but we have to allow the market to deliver to these inefficiencies again. And if it's going to go through them, which is a normal characteristic, especially if we're anticipating a early session start to determining a bias, well, we wait for it to trade through it. And if it's going to go through that, what's to the left of this? Relative equal lows and their sell side. So at that price level right there, we have 562. Market drops all the way down, clearing out all the way to 544.5. So it's allowing for any liquidity that would have been trailed from that low. They cleared that out. Took it all the way back up to opening range gap, failed in that little area I told you we needed to get through, broke lower, swept one more time, rejection block, didn't get the consequent encroachment of that wick. We didn't get the consequent encroachment of the lesser wick either. It goes to just short of the, where's that, right at the quadrant. So quadrant on the initial wick hits it perfectly to the tick. But the point is we didn't get to what level? It's midpoint. On either this wick or that one, it stopped. Went right to the rejection block, which is why I was mentioning, so we just cleared the rejection block, watch that wick. So your observation and your takeaway for this is you want to annotate how this low stopped directly at that wick's upper quadrant and did not touch its midpoint. See that? And then how fast did it run? Where did it go to? Where are the bodies right now? We cleared the short-term high right there, but we're working inside the opening range gap. So we've completely overlapped all this and we're banging up against the high of the opening range gap, which is the settlement on regular trading hours on Friday. See that? You're spending a lot of time in here. I would not bet against that clearing a higher high. And it's very confusing for someone, but that's the reason why you have to know what you're looking at in relationship to time. Visually showing price action around regular trading hours and electronic trading hours, you have to get used to seeing that. And also, while you're watching price action, if you're trading like in the afternoon or if you're trading in latter portions of the morning session and you're on lower time frames, if you're toggling back and forth between electronic trading hours, this is what I'm showing you here now, and regular trading hours. I've done this in the past where I've referenced something, and because I referenced it on either electronic trading or regular trading hours, I mistakenly put more emphasis on something that should not have had the emphasis placed on it. And I discovered, oh, there you go. I made a mistake by having either regular trading hours on or electronic trading hours on. So remember I was telling you about the Jackson Hole Symposium and the characteristic of that week? What does price do? It overlaps back and forth the previous run. 930, we drop down, overlap that entire run. Here, we drop down. Here, overlap the entire run right above this high. And now what are we doing? We're overlapping all this price run here. And what are we doing? We're redelivering all of this run from here to here. We're overlapping it. Now watch the wick. This one here, we just touched it there, and the larger one. So it can spike up with a wick. Touch that one. It'd be great if it didn't touch the new day opening gap low and then rolled lower. That'd be good. You can see a sustainable price run then. lectures around FOMC. At 2 o'clock, there's an initial run, and then at 2:30, it usually is going against whatever you saw going into the 2 o'clock run. That's a two-stage delivery. Going into 2 o'clock and then 2 o'clock to 2:30, whatever you see there, directionally, you have about 70% likelihood that it's going to do the opposite direction, and it's going to be extremely much more exaggerated going the other direction. It'll reverse and do the opposite direction and go the biggest move of the day will be opposed to what you saw going in at 2 o'clock as it traded to 2:30. And hold on to it. Hold on to it to around 15 minutes after 3. And just, if you look and study that and see that that's usually the winner, you want to be getting out early on. So about 15 minutes after 3. Why? Because that starts your last hour macro, one of 4 macros that are in the 3 o'clock to 4 o'clock time window. That's the only time of day that there's multiple macros in the same hour. All right, so now we've taken sell side out below here. Watch new day open gap on the 16th. This is the last attempt. If it breaks this low here, I'm going to move to the sidelines, and that would be enough for today. But I want to see it now start to find some footing. Go back and use this wick here. So I'm watching this level right there. If we open on another candle, come back down and touch it or fail to touch it and rally, or just run straight from here. Either one's it's good, but I'm watching this like an indication of strength because this level is a discount array right now. Where's price? Up here. Below it, we have what? We have this little bit of a gap. We have the new day opening gap high, consequent encroachment, the new day opening gap low, and then below that, we have this balanced price range of this wick and that wick. But in the middle of it, we have this midpoint of that wick there. So my eye's jumping to that. Now because it's taken off like it has, I don't want to see it come back down to this level now at all. So let's use this information. Say you would have taken this as a long. I would use this level here. Any stop would have to be below that. And it would have to be below this low here. Because this wick up and this wick down, it's traveled back and forth in here. So that portion right below that, that would be a place for a stop loss. Using the ideas of trailing stop losses, stop placement, that type of thing. I would not be long, but if I were, this is the type of thing you guys are asking me all the time. How do you arrive at where you're placing your stop loss? It's a lot of these things as I'm watching price. And if I see these things start to form and I'm in a move that's going up, or if I'm in a move that's going lower and I see the opposite side and I start seeing these barriers where price has done multiple passes through after it's done something. Okay, well, what is the something that was done? Low, lower low, so that's relative equal lows. Big liquidity resting below that. We dove down below it. So it's been made jagged down here. So where is it smoothed? Here and here. So now we have a fair value gap there. So this could be viewed as breakaway. This could be a common gap, which can fill in. It can come down and give an institutional order flow entry drill, which is just below this wick, then leave a portion of it open. It can completely overlap that and close that in. It's fine. There's the wick. We went one tick below it. Look at the low of that candle. That candle's low is 580.50. The next candle's low, 580 even. So it went down 2 ticks just below it. Now we're into it again. That fair value gap is what I'm referring to. Ideally, if it really wants to take these areas up here, it'd be wonderful to see it leave a portion of this open. It can close it, but every fair value gap that we're looking for as a means of supporting or providing a market propellant, we want to see it stay open. Some degree of the inefficiency stay open, because as long as it starts to do that and it starts gaining ground and moving higher, that's supportive to your trade. So how do you hold on to trades and have confidence? How do you hold on to trades and not get scared out? Well, it starts with these types of things. And you still will get stopped out of trades. I told you that we want to see the candle here drop down just below that. It did it 2 times and then delivered a run here. So there's the gap. That's where I told you the institutional order flow entry drill would form based on that candle. We want to see it stay open. What does that mean? Well, it went down as far as that low. Did that low touch this candle's high right there? No, it didn't. So what did it do? It went down one more time and then rallied. But what did it create? This down close candle. This right here is an order block. The high of that candle right there is 19,591.5. The next candle, we trade above it, and then we have the low of that candle, 590.75. Did we get the touch of that? 1 tick away. So if I would have had a pyramid entry, adding more to it there, I would not have gotten the fill on that. But we gave you the institutional order flow entry drill here and delivered beautifully. So if you're using that as your entry model, 19,580.75. That would be your threshold that it had to book to. So that means your limit order would have to be right at 19,580.5. So if that's the low you need to breach, it does it here by 2 ticks. You're filled on that one. If not, you definitely were filled on this one. And what's your heat? What's the drawdown on that? So it's 2 handles or 8 ticks. So that's the heat you felt. $40 per contract on a standard contract. And then it runs. What's your first threshold? Let's see if it can touch what? New week opening gap, low of this week. That would be your first threshold. And then can it reach to halfway? You measure that out. There's your half. And then you watch. Does it have speed to get to the upper quadrant? And if it gets to the upper quadrant, it should pierce right through the high of new week opening gap. Why? Because these traders that have stop loss orders sitting right at those really smooth highs, they're not going to want to give them an opportunity to get out of it. Ta-da! Just like that. See how it was like real energetic, punching up there? Look at the bodies right here. See how they're using that old reference point of the opening range gap? We passed and closed in that opening range gap here. We passed into it here, reacted off of it, nice. And we went back into it again here. And what did we do? We wicked through the new week opening gap high. And admittedly, I'm very surprised. I thought for certain when it first punched up like that, my eyes got, I was deceived by what I thought was the real quick punch through. I thought it did that, rally through that. But this is enough from the institutional order flow entry drill down here because we're teaching entries. We're teaching what it looks like. What is the logic behind it? Why should it do this or that? What is favorable? What is unfavorable? This is what it should do if it's good. If it does this, this is still good, but it's better if it didn't. So far we've had this area here. Remember I was telling you, watch this area. It needs to get through that. We wicked through it. We went through the new week opening gap. But from here to the new week opening gap high, so we have worked this level. So we've seen it get made jagged down here. These highs were buy stops. They wicked through it. And I'm admittedly surprised that they did not take that. I'm not convinced that we're going lower because they'll be leaving them intact. I don't believe that's the case. What I'm looking at is, do we wick down below the new week opening gap, trade into this balanced price range, and then one more time send it up into here? That's what I would like to see delivered. But that right there, son, is one of the elements of how you're going to use the fair value gap. The time when you hear me talk about this gap, this candle was forming, and you would take that candle's low, assuming when the next candle opens, it didn't make a lower low on that wick. That candle here, we opened up here. There's time to drop a limit order in right below that low. One of the things you can do is you can set up limit orders and have them 100 some handles or so away. That all you have to do is just drag them to a location when you're expecting a silver bullet to form. It's a 10 o'clock fair value gap that is easy to understand because now you've seen what happened. There's been a disruption. There's been a shark frenzy. There's been this evisceration of orders below that low and that low. Dove down below it. Then the market gets back above. We want to see it touch the new day opening gap high, minimum, or consequent encroachment, or the low. But we don't want to see it go below the consequent encroachment of that wick on a closing basis. Ideally, we don't want to see it trade to it at all. And it didn't do that, right? So it was very easy for me to say that it's going to go below that candle's wick by 1 tick. And I was technically wrong because it only went down 2 ticks. That way, it completely strips away all of the necessity and the fear of where do I buy it inside the fair value gap? You don't. You buy it at the high of the gap plus 1 tick. That assures you that you're going to get filled. And it's also doing what? It's allowing you to sit in a little bit of drawdown, and it's normal. But what happens if it goes down and stops me out, Dad? Well, that's a stop out, son. I mean, that's what's going to happen to you. Come down outside of the new week opening gap here and then price higher. I would want to see speed and distance now because we've already been here before. But going back to order entry, that you can use the gaps to measure market structure. You can measure the strength or weakness of an underlying move. And what I've mentioned the last 2 weeks in live streaming. Whenever we're looking for a PD array, if they are not traded to, or if they, for instance, like a gap, if they don't completely overlap it, like we were outlining here, I was saying at the time, let me make this a little bit larger. If we look at what was being spoken about that gap, when this was forming that candle, this candle had not closed yet. The next candle, I want to see it drop down right below that candle's wick, which it does here. You may or may not have been filled there. And I've seen it happen with me. It's an occurrence that's going to happen to you because you're trying to be so precise. You have a margin for error for that to occur. To prevent that from happening with your entries, you're going to use that candlestick's low plus 1 tick above it. So the fair value gap, we don't need it to come all the way down to the low end because that's what folks that are prematurely trying to teach my concepts, they're saying that you can get filled at the low end and you'll have the best and your stop loss will be micro, short, and small. You don't need that. If you haven't picked up on what I've been laying down here, knowing where the market's going to gravitate and draw to is more important. Which has more impact on trading, not just your trading, but everyone's trading? Your ability to get in on this fair value gap that maybe not 75% of the people that trade even are paying attention to, or where the market's going to draw to because there's stops resting right up here. Clearly, it's where the market's going to go to. So if we have done the work and we're laying the groundwork and foundation for that to determine where the market's going to go over the course of the session, over the course of the day, which we haven't got to that part yet. So far, we're only working with session draws on liquidity, and they're dynamic. Session draws on liquidity are dynamic. That means it's above and below. You have to start there. You will not know how to derive the daily bias until you get good at knowing how to determine what side of the session bias is going to be the draw. But if you can formulate an entry mechanism that affords you, number one, a high precision entry model, which is obviously institutional order flow entry drill, you don't want to see that gap filled in. But what happens if you get filled and it does close it in, Caleb? Nothing. It just means you have a little bit more drawdown. It's not that much from this candle's high to the low of that one. So what is that? 5 handles or so? Factor that in with commission. You're watching and observing. You're waiting for the still waters to be disturbed, watch the water turn red, and then look where is it smooth. I gave you both sides of the marketplace. That means you're looking at both ends of the session. Session liquidity is above and below. All you have to do is wait for them to do the damage. What's the time window? You're going to see it at 10 o'clock. That means you have to wait that first 30 minutes. Why? Because that is the opening range. When you're watching price action, you're looking all through that first 30 minutes. Your eye is going to where is the initial legs of liquidity. We gave them to you. Here is the buy side, and the sell side was over here, here, and here. And how far could it reach down, Michael? Remember I was telling you that? It can trade down to that new day opening gap. It can trade down into that. And if it's going to trade through that, we have that low right here, which was in view when I was showing you all this stuff anyway. Then once it does that, it rallies back up to opening range gap, closes it in, drops one more time, overlaps into all this, the rejection block. You heard me talk about that as it's happening. Come back down, hits the new day opening gap from the 16th, rallies back up in. Look how the bodies are staying here. Remember I was saying, listen to this part, okay? It's spending too much time inside of the opening range gap, meaning what? They're not in a hurry to pierce this high, much more meaningful than they did here. So this high and this high is still relatively clean. That's just tiny. It's little. That's a little bit of movement. That's just like when I was telling you the description when your child's coloring, they color outside the lines. You don't look at that as a failure. You don't say, look what you did that wrong, and smack them for it. You're going to hang it on your refrigerator because it's your child. Well, same thing here. When the algorithm is trading just outside of the lines, it's okay. It's doing everything it's designed to do. To get that price high booked, it's got to go above it because there's a spread. That's all it did there. Did it close above it? No. Did it have much more meaningful movement beyond that? No. Did it trade to the high of the new week opening gap for August 18th, this week's new week opening gap? No. So what is it leaving? It's leaving this liquidity and making these individuals over here feel safe. So what is it going to inspire if it sells off? Shorts to do what? Place their stop loss above here, or if they have deeper pockets, build it right there. So this is engineering liquidity. It drops here. I said, take your attention over here to these wicks, here and here. We watched it drop down below it, took out that low. And now I said, now watch. What I want to see is, does it get back above the new day opening gap on the 16th? And then does it come back down and touch that there? Yes. I don't want to see it trade down and below that wick's consequent encroachment. It never did it. If you're brand new, you don't know what you're doing, and like I'm telling Caleb, you don't worry about this. You wait for 7 o'clock and you look for relative equal highs and relative equal lows. Well, guess what? That's this, folks. That's the relative equal highs after 7 o'clock, right here. Here's 7 o'clock. It rallies. We're waiting. 9:30 opening bell, all the way to 7 o'clock. You're going to look back through that. So if you're going to not be an early trader, you're going to start looking at the market at 9 o'clock, go back to 7 o'clock. So you're looking back through the last 2 hours. You only have to look back through the last 2 hours to see where the liquidity is. So here at 9 o'clock, right there, what do you have? High that's lower than that. Isn't that a relative equal high? Yes. What are these? Relative equal lows. So what is it doing first? It runs above these highs there and then creates what? Another smooth relative equal high. But then what does it then do after that? It breaks lower, takes out the liquidity here, and we're watching the opening range. What's it doing? It's finding responsiveness at the midpoint. It has no ability to get to the upper half of it. So what's it going to do? Go back further to 7 o'clock, but anything prior to 7 o'clock, well, what does that take you back to there? Which is what I referred you to when we were, entering into that 9:30 opening. Where's the liquidity at? Here and here. And what did the market do? It addressed what side first? Here, after 9:30. So did it go for that liquidity or the sell side over here? It went for the sell side first. Came back up. Did it take that liquidity out yet when it was here? No. Did it take it out right here No. So where'd it go? It went below one more time here. We were looking for it to sweep down to here. Then as it was dropping down, I said, watch these wicks in here. It overshot the entire low. That's fine. We're not in a trade. We're not getting stopped out. We're observing and watching. What are we waiting for? We want to see it take that low out. Drops. What is this forming? Relative equal lows for anybody that's trading to 9 o'clock. Going in, waiting for what? The first 30 minutes opening range. High, high. Relative equal highs. In an area I told you this is going to be problematic. We need to study this. It's going to need to get through this little area here because there's two indecisive candles. Even though that this candlestick's closed and this candlestick's open, is basically symmetrical. It's close. It doesn't really provide a gap. When I see candles like this in the middle, two of them like that, that to me is something that needs to be repriced to. And if it goes through it in the direction I'm looking for it to move, then I'm fine with it. Then I'm going to disregard it and never worry about it again. And it couldn't do it. Went lower, lower, rallied one more time. The body's staying inside the opening range gap. Just bumped that high and then took us down to clear this. I told you once it done this, I want to see it trade above the new day opening gap on the 16th, come back down, touch that, and it did. And then I gave you, because of all the things I just outlined, which side did it work predominantly? The sell side. What is the side of the marketplace usually offered to the public first? The wrong side. In the market, they send the traders on the wrong side. That's the Judas swing. That's the run on price action that gets people thinking, this is where it's going. I want to get on board, and they chase. And if they're initially positioned to profit while it's forming, it gives them a sense of like comfort when you shouldn't be comfortable. It's usually the wrong side of the marketplace. And then it comes down, takes the low out. And remember I was asking, do you feel safe if your stop was here? That's me priming you. I'm priming you. As a student, he's taking my attention up here. And I said, now what about the people that had their stop loss here? Who's made money right now? Shorts. Anyone long from that low is now unseated. Why did they do that? Because they're going to go here. So to run from here to here is profitable. To run from here to here is profitable. And why it went down there is to unseat the stops that were resting right below that low. I took your attention to this area here. Told you the fair value gap was going to be there before that candle closed. One tick below this candle, that's the institutional order flow entry drill. And we don't want to see that entire gap closed in. That gap looks like this. That's your fair value gap. It went down to this low. Is that still on build? Of course it is. That's exactly what you want to see as a signature. When it does that, it's going to be what I want to see. We want to see it rally up. Where is it going to rally to, Michael? New week opening gap low. And then we want to see it trade into the midpoint of that consequent encroachment. And does it touch the top of it? Look at the bodies respecting it again. Yeah, we wicked through it. And admittedly, when I said it, say, yeah, boom, it happened. I thought because it flashed real quick, my eye was watching that. This line, I thought that was this over here. And it had to dig down. And I told you, okay, I want to see it go down into this area here. And there's a balanced price range in there. So it can do that and then send it higher. These things that will repeat over and over again in price action. The logic of waiting for the sell side and the buy side, once you define what they are, just wait for the first one to get taken. When that water is disturbed and you see violence, jagged, 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 the whole time, these are smooth and this is smooth. Oh, I want to be able to buy down here. Well, when it goes below that, you buy it then. Learn from that. Sometimes it'll be great. Sometimes it won't be. We want to see it trade above the new day opening gap. That means I'm saying that once it gets above that and it starts to trade here, as long as we don't breach that midpoint of that wick right there. Why? Because we've had the stops run below that low in here. So this movement is what? It's a wick on a higher time frame. It just doesn't look like one. It's wicking here to take us below that low and that low. So this low is the low that forms what? These relative equal lows. And it's also being respective of the new day opening gap. See the bodies? Is this one doing it? No. That's logic. I'm not going to refer to this one as we go back above it as support. I'm going to use this one because this one here is already showing that it's done what? It's respected it. So the algorithm is going to go back to that one. It's not going to refer to this one. Which one was on the new day opening gap and the bodies are showing it right there. So now my attention was focused there. We went above it. I want to see it trade down, touch the new day opening gap high. And it can trade as low as that low one, but we don't want to see a close below that wick midpoint or consequent encroachment of it. And it only gave us a touch of the high of the new day opening gap, rallied, showed displacement. Wonderful. Next candle as it's forming. This is going to be a fair value gap. Called before it formed. Institutional order flow. Called before it delivered. It did not close in that gap, which is exactly what I told you. That's ideal. And then it's off to the races. Look how it responded off of the consequent encroachment of the opening range gap there. Isn't that beautiful? I said, think of this as a individual bar for a daily chart. But if this is the daily range, an open, high, low, close bar. So this is the open, this is the lowest it made for the day, and this is the highest it made for the day, and this is where it stops trading. If your thinking is that we're probably going to move up over a series of days, or for the week, or for the month, or we're moving in that direction higher, and you're watching price action at 9:30 here, and you've defined the sell side was here. We incorporated that old new day opening gap, and we gave you the buy side. So if we're opening right here at that candlestick's tick opening, if that opening price, so that opening, we opened, went up, closed down. That opening right there represents this graphically in my diagram. And then from that opening price, that movement from here to that low would represent that low on the daily open, high, low, close bar. So what we're saying is the open and the initial drop down, that's the fake move. That's the Judas swing. That's where smart money buys. Now, the complication comes in at where you are going to be a buyer. I don't expect my son to be a buyer down here. I don't expect him to buy the rejection block. I don't expect him to buy down here below that low. That's too much of an expectation placed on him. It's going to take him a long time to try to buy below here. But that opening price here down to that low in that area, that range, that means where this low forms and where the opening is, you're hunting. You don't have to have the low tick. You're just hunting something to be long. You can feel confident that when you're working towards holding on to trades that pan out longer term, this movement from the opening price down to that low, that range graphically looks like this. That little sweet spot right here, inside that range, that's where your best opportunity to buy and hold, and just wait until we get to the lunch hour and then measure out where it can retrace. So if there's going to be a lunch macro, if it's going to go lower, you can determine where it's going to go lower and not place your stop loss within grasp of that. Don't think that this is a one-trick pony, intraday trading only, and you can never use it to make bigger money. You can, but you can't appreciate this type of daily candlestick close until you first learn how to read these intraday price fluctuations. Because by doing it this way, number one, you're going to get a lot of exercise. You're going to get a lot of price action to digest and learn from, because everything I'm showing you here is fractal. You can apply it to a weekly chart. You can apply it to a monthly chart. You can drill down to a 5-second chart. It's still there. What do you want to do with it? How you want to frame your model? But for folks that want to use this for longer term, holding on for the longer term range, so we have the opening, which is that price there, and any movement down. We don't need it to tell us in advance what the lowest low is. See, that's the part that's going to hurt you, because you're thinking, I need to know how to buy below the opening price, because that was my biggest challenge. And I teach it's power 3. So if we know the opening price, that's a finite number. They're not going to move that around. It's right there. It's the opening tick on that candle. Then simply wait for it to drop. Aim for liquidity or aim for any inefficiency below that price to the left over here. Okay. The first stage is where the sell side liquidity and then that new day opening gap. It pierced through both of them. And then what did it do? It came right back to opening range. And then I said I was spending too much time into it here. And then it drops, takes out that low. Then I took your attention to that wick, the midpoint of that, and we want to see it get above it. Treat the old new day opening gap. Now, let me ask you something. If you didn't know about the new day opening gap, why would you expect this candle to drop to that level right there and then send it higher? Why would you expect that? You wouldn't. Taking your attention right there, it's going to form a fair value gap, and it's going to be an entry that's an institutional order flow. Entry drill. That means it's not going to close the gap in. It's going to leave a portion open, and then it fucking does it. What's occurring? This fair value gap with the institutional order flow entry drill and leaving that gap open, where's that forming in the context of the daily range based on this logic over here? It's inside that open to the low. Open to the low. Look, I'll use the same thing. Graphically depicting. I'm not predicting the closing price. Don't get me wrong. I'm just saying, if you go in every single day with this logic while you're learning how to do it better, this is how you grow in holding on to trades, and eventually you are going to catch a fucking tiger by the tail. And baby, when it starts running, you better hold the fuck on, because you're going through all kinds of shit. Sticker bushes, water, dry ground, rocks, tear your ass all up. It's going to be hard to hold on to it. But at the end of the day, when it closes like this on the days that it doesn't, man, you've made tons. And it fixes all kinds of drawdown. It fixes all kinds of days where you did too much and you gave back wins. It fixes all that stuff, and it smooths out your monthly equity curve. So eventually what happens is, by entering like this, when you have a longer term bias that you derive from a monthly and a weekly chart. So eventually Caleb's going to determine where in that spectrum his trades should be focused on. So if you're bullish longer term and you think that this is the criteria that the daily candles are going to form, or the day that you're trading is going to form this. So this is basically like 5 o'clock or 4:15 Eastern Standard Time, that closing price. In relationship to where you opened up at 9:30 down here, that's bullish, isn't it? How can you hold on to those trades without having a whole lot of fear, anxiety? You have to determine how to buy at the open or below it, because rarely will it go back down after it runs up here. It rarely goes back down here. If it does, it's probably not going to create this condition here. So why do I teach you to take partials? Because you don't know when it's going to turn on you. You don't have the advanced understanding. You don't have the experience. You don't have the time invested in knowing how to navigate price. You don't know. You're going to react to everything adversely. Everything. When you're making money, it's going to scare you shitless. You're going to know what am I supposed to do? I was hoping I was going to move up 20 handles. It just jumped 40. I didn't put a limit order in. What the fuck do I do? I'm making more money than I was supposed to. What am I supposed to do? That's a good problem, but you're going to get panicked by that. And you're going to hold on to it too long because you're not going to notice that it's caused a reversal because you don't have the experience. And that's the first time you made big money. So by entering in after what side of the marketplace, and it's liquidity, relative equal highs and the relative equal lows I gave you this morning. Which one does it hit first after 9:30? Bang. Okay, so what does that tell you? That's the first stage of catching a power 3 day like this. If you're going to try to hold for a long, big up close day, it has to drop down and take the sell side first. It did it this morning. But everything is a graduated understanding. When Caleb sees that the sell side's taken first, okay, that means it's going to reach for the buy side. When we're bullish, well, what makes us bullish? Well, what we just watched today. It took the sell side first, and then it reaches for the buy side. After seeing that for days, weeks, and months, you get comfortable with that idea. You don't need somebody else to tell you in another video. You don't need ICT to answer your question about the bias because you've already seen it. The next graduated step is holding through lunch. Aim for 130. Close your trade entirely at 130. If you're in profit, close it. And you keep doing that. And then eventually what you'll do is you'll watch and see that eventually you'll start seeing the days that do these types of things, they close near their high, but just off the high. And you'll see that during the last hour, it creates that far extreme high. And then right before close, it comes off that. And that closes just a little bit below where the highest high was for the day. But I want to go into the 15-second chart because I said we were going to do that. But I also want to refer back to this little area here. So when the market was creating this little run, what I was anticipating is that they were going to take this relative equal high out. That's what I wanted to see. And I felt that we were going to work at least in the lower half of the new week opening gap, which is this is the new week opening gap low, and this is the new week opening gap high. All this price action here on a 1-minute chart doesn't look as clear and obvious as it will when we look at the 15-second chart. As price creates this price run in here, I've already saw this low, this high, and that low on a 1-minute chart. When I'm watching price action, I'm looking at a higher time frame chart. And if I'm looking at something on a 5-second chart, or 15-second chart, or 30-second chart, anything sub 1 minute, I have to anchor some logic as to what I'm expected to see on the lower time. So for a 15-second chart, all of this run from here to here is going to look different. There's going to be some, not always, and there's not going to be always a overlap of the same inefficiencies. The same gaps that would exist on a 15-second chart may or may not exist on your 1-minute chart. It certainly isn't going to likely appear on a 5-minute chart. So price delivery continuum theory is where we have something identified on a higher time frame level. When I say 1 minute, in deference to a 5-second chart, 1 minute is higher time frame. It's not a significant higher time frame because it's only a 1-minute chart. But if I'm going to engage price action with the basis of a sub 1 minute chart, that means 5-second, 15-second, 30-second chart, 45-second chart, something to that effect. I'm leaning on the logic that the 1-minute chart is subordinate to something higher than it, which would be the 5 and the 15. So if you do all of your study initially with just a 15-minute, 5-minute, and 1-minute chart, you will have a solid understanding of price action. It doesn't mean that you will know when to hold for long-term up days or down days. And it doesn't mean that you're going to hold for the weekly range. It just gives you opportunity to practice and study where and how price delivers. And the relationship between a 15-minute time frame, how it books price, and then what it looks like on a 5-minute chart and how it books price, and then a 1-minute chart. But when you go down to a 15-second chart or anything less than a 1-minute chart, you're going to see spotty price action that is many times acceptable in that time frame. But when you start seeing things that agree with, say, a 1-minute chart here, then it's going to be a matter of, you should be seeing the 1-minute chart with the opening range gap shaded here, but it's the portion, the lower half portion here of the new week opening gap. So the new week opening gap high, new week opening gap low. If we measured that like this, see that right there? That's the lowest quadrant level, okay? It can trade to the midpoint, but what's a low-hanging, low threshold objective if you're going to target something going long? The lower quadrant, right? Or the low. So if I think that I'm looking at a marketplace that's trading off of this breaker, low, lower low, high. This retracement, every retracement that sees it break to the upside, that's a breaker. Inside of here, in this range, that last up close candle, what is that? That's a bullish breaker. We're trading down into it, and then we have a shift in market structure right there. I want to see when this gap formed on a 15-second chart. All these boxes here are relative to a 15-second chart. But I want you to look at the logic on a 1-minute chart. Shift in market structure on that candle right there. Then we have the candle close here. So now on this time frame, we would have this big paradigm shift about to take place for you. You would see that gap, and this is institutional orderflow entry drill right there if you were trading on the 1-minute chart, because you don't want to see this gap fill in. This smaller gap that's a different shade of color, that is inside of that gap because it's a 15-second buy side imbalance, sell side inefficiency that you want to see what? Stay open. Then you want to see it displace higher, proving that this is going to stay open. And then we have what? This rejection block is pierced right there. So then on the lower time frame, 15-second chart, when it trades into this gap that will be based on a 15-second chart, and it's also, what is it? On a 1-minute chart, what is this? That right there. It's a wick. Half that wick because it's treated like a gap. If we measure that, half of that is this. So when I'm watching price action, I don't just look at one time frame. I have a continuum of price from a weekly to a 5, 4, 3, 2, 1 and sub 1-minute chart time. And I'm reading price action like this because that's exactly what the algorithm's doing. It's cycling down and then going right back up through the time frames. So if I know I'm in an area where the 1 minute is in a buy program, if it's going to go up, where's it going to go to? New week opening gap low, because it's going to gravitate towards these new week opening gaps. It's this week's new week opening gap. It's a highly influential price action. It's like a black hole. It's not going to escape it. It's going to draw it back in. Well, we're down here waiting for it to prove that it wants to go up. Wonderful. I don't need to be a buyer down here when it's sloppy. I don't need to buy this institutional order flow entry drill on the 1-minute chart. I want something that is in line after it's occurred. It's done this movement here. And then I have this wick on the 1-minute chart. That means that when we opened up here and create that separation between that wick's high and that candle's close, wonderful. The next candle we open up here and does what? It trades down. There is no gap right here on the 1-minute chart, but there is a consequent encroachment midpoint of that gap on that wick because wicks are gaps. So when we see it drop down like this, as it went into that, I hit it market, rallied, and then it showed this imbalance here, trades into that, and then delivers up into the new week opening gap. Because I'm trading pre-session, I'm using the logic of relative equal highs over here. So now watch what occurs. In price, I know that there's liquidity up there. In this 2024 mentorship, I taught you to validate a relative equal high. It is a high that has a slightly lower high to the right of it. That's a valid relative equal high. That is where your liquidity is most likely going to be tapped. Can it run relative equal highs that have a slightly higher high than that one? Sure can. The key is, and this is the part where you write down shit, if you watch that one that has a higher high, if it makes the higher high with a wick, but the bodies are still showing this body close is slightly lower than that one. If the one that you think is a relative equal high, if it wicks above it, but the bodies still stay below than the one to the left, that's still a valid relative equal high, and it'll go into the wick. You need to see it trade above and close and show speed and magnitude above. If it has a wick, it's consequent encroachment. Okay. Remember what we were looking at when price was diving down today below its initial low after 930's opening? I said, watch the wicks. That's why you need to see, does it want to indicate that it wants to go through that? If it does, then you probably are part of a more meaningful run. Or if it does that, give it a chance to reverse and get back above it, which is what we outlined this morning, and then trade to the opening range gap again and to right to the buy side liquidity I outlined. See how all this stuff goes together? It's logic that will repeat for you. So this is the draw on liquidity, right? So your buy stops are here. So that's where your buy side liquidity is. This is the entry. It rallies, creates an imbalance here. Notice that this imbalance doesn't even match on the 1-minute chart, but we're watching it on the lower time frames. But again, what is here? When price goes above it, do we just disregard this? No, we don't do that. We take and you measure it on the time frame it exists. So there is what? Consequent encroachment. Do these candles touch that consequent encroachment? No. So while I'm watching price action, I may be showing you the execution being recorded on that one specific time frame. What am I not showing you? It's my observations through the price delivery continuum. It's watching higher time frames down to lower time frames. And I'm weighing out, do my PD arrays keep price from dropping? Or if I'm expecting this consequent encroachment to trade to, which is reasonable, it's consequential. It's consequential to you holding onto the trade. So it can encroach into the mid part of that wick, hence the name, consequent encroachment. If it fails to touch that midpoint, is that a good thing or is it a bad thing for my trade if I'm long? That's exactly what I want to see happen. But you're watching time frames that are higher down to the lower time frames. You're going to see things on the lower time frames that you won't see on the higher time frame, for instance, the 15-second chart. I'm managing the expectation of what the 5 minutes doing, what the 15 minutes doing, and how many things are forming on that 15-minute chart. It's not forming like on a 15-second chart, and it's behind you after it forms. That means the price is advanced. If you're on the right side, you're moving further away from that thing that occurred on the 15-minute time frame. For instance, say this gap down here was based on a 15-minute time frame, and we're trading here. Is this all that influential in terms of watching price action at that moment there? No. So as I move away from the higher time frame PD arrays, that's supporting my confidence that the trade's panning out. I don't need to worry about the 15 anymore. My focus drops down to the 5. And as long as I'm moving away from the PD arrays that's formed on the 5-minute chart, then that's wonderful. That's exactly what I want to see happen. But I'm watching that 1-minute chart. And then same thing, because 1 minute is going to be closest to anything less than a 1-minute chart. So the PD arrays that form on the 1-minute chart, if I'm working with a 15-second, 30-second, 45-second, or a 5-second chart, I am very, very hawkish over the 1-minute chart. I'm watching every PD array. This is an example. So if I have a wick here, the midpoint of that wick, I'm watching as it's doing this. I could see it touch that, but I don't want to see it touch it. I want to see a level that could support, but not touch it. That right there is a whole paradigm shift. If something is reasonable to assume that this is likely to happen in price, but it can't even do it, it tells you without a shadow of a doubt, it's immediate feedback. This motherfucker's going up or going down. And think about it. Never thought about it like that, have you? Right, because I take everything and turn it upside down. And when you do that with trading, it works. If you do what everybody else does, you're going to get the same results. 90% of people lose money. But that right there sets up the tone for it to run higher. How high can it run? Well, the draw is the new week opening gap low, right? No, because that's equivalent to and below the relative equal highs. That's over here where the stops are. This is where real orders are. Anyone that's been short, they have stop orders right there. How do you protect a short position? You put a buy stop on it. So if it goes up to that level, you want to be out because it could keep going higher. You don't want to hold on to unlimited risk, right? So above highs or a singular high after the market's dropped, you don't need a book map to tell you that there's buy stops above that. So you can't use the new week opening gap low, which is that big bold line here, because the barrier to getting to the liquidity is above that here by that candlestick's high. So right away, we're met with, this is the initial interest. Can it trade there? And then if you start doing calculations on my other chart, because I have monitors in front of me, and you can see that if you go on my YouTube shorts. For the people that go through it and start trying to study it this way, it's going to unlock a perception of price actions you've never seen before. Everybody has a 15-minute time frame. Everybody has a 5-minute. Everybody has a 1 minute. But how they manage it, the continuum of how price is delivered through that mechanism of higher time frame down the lower time frame and then back up, not just one side. It's got to go back both ways. And you're constantly weighing out what feedback you're getting with the PD arrays I teach. And when you can see the price action doing these elements and how it supports price continuously moving, it's not being negated. It's not eating into levels that would otherwise be problematic. Everything's supporting each other. It's literally looking at how price refers to liquidity and inefficiency in the spectrum of moving in a predetermined level above these relative equal highs. The question is always, where is price drawing to? Well, where's the relative equal highs and relative equal lows? Once you determine that, how far beyond them can it reach? What end dog or new week opening gap is existing beyond them? Because that's where it's going to gravitate to. So we have the buy side here, these relative equal highs at the butt end and into the lower quadrant of the new week opening gap, which is defined by that high here, this line, and this line. The midpoint of it is here. That would be consequent encroachment. But because I want to have the lowest threshold exit, I want to show my students how to do that. Yeah, it could trade there, but what's before that? The lower quadrant level right there. So to get this price, it's going to have to book what? 19,610.50 or slightly higher, right? So if that's the case, we're going to have these levels here, and just know that line, once we get above the blue line, which is the buy side liquidity here, if we have that on our chart, we can look at a 15-second chart here. All of the things that are over here on this chart are being shown to you on a 1-minute chart, and I'm watching on a 15-second chart. Now, 15-second chart, your first time seeing it, you're going to think, I can't use that time frame. It's too fast. It's not moving any faster than what that 1 minute and the 15-minute time frame, the hourly chart, the daily chart. If you're watching ticking price on a 15-second chart, have a daily candle chart right next to it, and you'll see it's not moving any faster. But because you're looking at the candlesticks forming closing, creating another one, open, forming, closing. It feels fast. But when you anchor it to a higher time frame reference point, like for instance, the 1 minute chart, the 1 minute chart is my guide on what I'm doing for a 45-second chart, a 30-second chart, a 15-second chart, and a 5-second chart. I've executed, and you've seen me do this with a 5-second chart, and it has the same measure of precision that I show on any other time frame. If I'm looking on a 1 minute chart like this, and I'm expecting price to gravitate up to right here as well on the 15-second chart, it could trade up to the halfway point of the new week opening gap, which is here, over here. But I want to be able to teach my son how to get very easy objectives where it's not hard work. It's more likely to fill this one than try to reach for something that's really high and lofty, because I've been in a pursuit of perfection my entire career. And every time I demand perfection while I'm moving in the right direction, sometimes I don't get my exit, even though the price can book there. So I have afforded myself a strategy that says, yes, I can see where the best turning points are likely to form, but on a steady diet, I need to know where the easiest barriers to profitable exits are going to be for me. Which is the easiest thing to get to? Well, it can't be the low, because that's where the actual relative equal highs are, where the buy side is. And it's just slightly above that. So that's that blue line, remember? And then above that, we have the lower quadrant of the new week opening gap. And then we have the midpoint of it. So this level here is the easiest threshold to exit profitably, even if I can't get the midpoint of the new week opening gap. So you see how I'm measuring with logic that it could go to a specific level that I can forecast, but rules state that to have a low barrier to exit profitably, what's the threshold prior to that one? Well, it would be the lower quadrant of the new week opening gap. And then as price created this level here that's green, I'm looking for that to be a breakaway, and it acted as such. It didn't even trade back down into it. And then we had this gap here from where we closed here. We opened on that candlestick right there, and there's an actual gap with an order block. This is a strong PD array. If you ever have an actual gap where there's no wicks and you see it after a down close candle and you're bullish, as soon as it trades down into that, that's a buy. But it's the gap. Even if that order block wasn't there, this would have been a fair value gap, and that's what's highlighted there in blue. As it slammed into that, I went long, entered at the market, and then we rallied up. In this area right here, that's this wick. That's what's being measured on a 1 minute chart. As price is going up, I'm watching the 15-second destroy the midpoint of that right there, which is exactly what I want to see. And then when we start to come back down in, I don't want to see it touched. Does it touch it there? No. Oh no, oh no, oh no. I want to see it come down here and not touch it. Does it touch it? No. Then it starts to rally up. Wonderful. Institutional order flow entry drill. Why? Because we have proof that it doesn't want to go down consequent encroachment here based on a 1 minute chart. See what I'm doing? I'm measuring the strength and the magnitude that's still possible in the delivery of the price, but I'm measuring the underlying strength and seeing, does this really prove that I'm on the right side? And is the market breadth in a visual representation, is it supporting higher prices? Yes, because if it was weak and touched this level here, then it's probably going to have a deeper retracement on me. I don't want to see that. I want to be a part of a trade. I want to add to trades that show me all these types of signatures that tell me, no, I can't even get down there for you, ICT. That means you're getting ready to go up for me, and I'm already on side. So I'm going to be comfortable, and then I'm going to make my target better. When it was just above that blue line, I raise it up to the lower quadrant. There's the buy as it happened in real time. Look at the little carrot that appears right at the order block. Beautiful, isn't it? That's the entry. Could you improve on that ICT? I probably could have by a tick because I was doing it with a market. Limit order, I probably could have done consequent encroachment, but risk maybe not getting filled. Like, that's beautiful. The market rallies up, comes back down, doesn't give me consequent encroachment touch there. All you have to do is know where the price is going to move. Relative equal highs. Okay, how far past the relative equal highs? Well, is there a new day opening gap or is there a new week opening gap just above it? Where is the close proximity? Use that one. If the range permits it, break that range or inefficiency into quadrants. Lowest quadrant right here. What's that price right there? To get that price, you got to book what? One tick above it. Bam. Look real close right here. You'll see the little arrow where I'll get out at. Bam, right there. That's the logic, folks. All right, so 930. Okay, so we ran up into the opening range gap, went above it a little bit, broke down. Here's a gap right there. You see that? We overshoot it a little bit. That's equivalent to a 1 minute mohawk. There's a little bit of a coloring outside the range. You have to keep things in perspective because this is a 15-second chart. Now, it sounds scary, like, man, it's just moving too fast. It's moving no faster than it's moving on an hourly chart. The only thing that tricks you by perspective is the frequency of a new candle forming. The range upon which it's moving higher and lower, it's not changing that. The same amount of time and fluctuation is occurring. Something occurring on a 15-second chart doesn't equate to or make a 100 pip or 100 handle run in price. You can't think about it like that. The magnitude or the distance upon which price is going to move is dictated by the time upon which that move begins. And that doesn't mean that you begin a move on a 15-second chart. It just gives you opportunities to engage what's going to be in play, higher prices or lower prices. Okay. So we're going to go into the second drop where we're spending too much time in the opening range. We're inside this inefficiency here. We drop down after working lower quadrant. We drop, institutional orderflow entry drill there, almost an immediate rebalance right there. If I was watching this live as it was going up like that, I would have commented, said, watch for immediate rebalance. Immediate rebalance is when you have a big down close candle and the next candle opens up and goes right back up to the previous candle before the down close or the larger range candle. And when it touches that right there, that's one of the best on-side indicators that you could ever get in trading. And when you're watching time frames and you're watching and managing your trade, any instance of that occurring and you have not had liquidity taken, it didn't happen yet until that right there. See that? So it could have very easily went up and touched that candle's low. And if it did, that would be an area where I would pyramid. If I was short, I would pyramid there. And I would look for this low to show speed through it. It does. And that would be first partial. But let's go to the conversation about what I outlined real time on the live stream. So we went down below the lows, low and a slightly lower low. So we went down below this low right there. This price action right there is this price action right here. See how I'm making that little box here on the 1 minute chart? It shows it here on the 15-second chart. So the market has a shift in market structure on the 15-second chart here. The same thing you see on this 1 minute candle. It rallies up. This is a breaker. This is a breaker. This breaker, this up close candle, extend that in time there. So you have a gap, which is a buy side imbalance, sell side inefficiency, and you have the midpoint of that gap, which is consequent encroachment, and then you have the breaker. So you have several things there. If you were watching a 15-second chart, or if I was trading on a 15-second chart, I would have tested the market by entering in here. Would it feed that idea? It rallies up, and it does. Then we said we want to watch it trade back down into the new day opening gap high, and maybe as low as the new day opening gap low on the 16th. Later on in the stream, I explained why, because the logic was over here with this. The bodies were respecting the new day opening gap high, and it didn't do it here. So which low am I going to refer to as a discount array? This one. Even though this is lower, I don't care about that. I want this one. Why? Because this one was respecting the same reference point I'm using to enter off of over here on a 1 minute chart. We want to see it open, trade down to that new day opening gap on the 16th. We get that here. Trades down, hit it, and then rallies up. Then we have displacement. We have a separation of overlapping candles, which is what we're seeing in here. All of these candles are overlapping. They're sharing the same price range. The highest high and the lowest low. They keep pricing them back and forth. And then we leave it right there. Wonderful. That's this movement right there on that candle on the 1 minute chart. When the candle I'm highlighting right there was still forming, had not closed yet, I said, we're going to see a fair value gap, and I would like to see it create an institutional order flow entry drill. That means go one tick below this candle's low, and then rally up to new week opening gap low, and then we'll see. Well, we get that here. Boom, boom, rallies. This, we don't want to see that close back in. Why? Because we're close to a target. And if it's going to go here, it's probably going to run this high because there's stops right before this drop down here. Anyone short, where's it going to place their protected buy stop at? Right above this high. So if it's going to go here and trade into this old opening gap, which is shaded in pink, that's the opening range gap. Price eventually trades up into there and hits the new week opening gap high. Look at the bodies respecting that on a 15-second chart. Then you have this inefficiency down here and go over to the left. See that? So this singular candle and this singular candle here are sharing space, the same range. And it passed through with one single candle on the downside here and on the upside here. We can see it drop down below the new week opening gap low and trade into the inefficiency right here. But this is a balanced price range because we passed through it here and we passed through it here. So between this candle's low and that candle's high, that little box is balanced. It's like a brick fucking wall. Why? Because it's in a buy program. It's going to be reaching for the liquidity here, and where we mentioned earlier. But the point was, I can see this. I'm watching this, and I'm pairing this up with this over here. So just as much as this is a balanced price range, this candle in the lower left-hand corner, that candlestick's high, and that candlestick's low, those two price points define where two candles back-to-back have traded in both directions, passed through multiple times in that range. So think about like a trading range, okay? You've ever studied the trading range? Most traders are doing what? They're waiting for the breakout. I'm not a breakout trader, but I can understand that when a market passes back and forth through a predefined range, high and low, it's going to take something significant to go on the other side of it. So if I can see those types of signatures in price action, it's two forms of it. Single delivery down here, one candle, and I mean it like this. Gap, well, now we passed through it. So we offered what here? Buy side. What's missing over here? Buy side, because I only had one single candle going down. So in a perfect world, a balanced market, a efficiently delivered market would have the range open all the way up to here and pass back through it. Because only this single candle for 15 seconds only passed through the range of the previous candle's low to the candle's high here. So between those two price points that's shaded in this blue, it only offered movement going to the downside. How many times could someone buy or sell in that 15 seconds? Not much. It's inefficient in the scope of price moving up doing that same price range, and we get it here. So because we have one single pass on this candle and this candle here, I see that visually as a balanced price range. It's offered both sides. It's true because we have not seen the buy side that was going to be targeted. What does the market do? It trades down, watch the bodies. The wicks can do what? Do the damage. They can trade outside the range. So I'm looking at this as a balanced price range, but I'm anchoring it to what logic on the 1 minute here. So the bottom of that candlestick right there. I'm not referring to the 15 second, but I'm anchoring it to the 1 minute chart. As I'm referring to this candlestick here and this candlestick, that's a balanced price range. But it looks visually like this on a 15-second chart. So there's more room for it to have this little errant price action there, but it's not errant on this time frame. Because watch, we're inside that balanced price range. It did not take out that candle's low. That's reasonable. It's like a brick wall. You're not going to go past me. Past what? The low of that range that's defined by that candle. Balanced price ranges are an efficient delivery mechanism. But if they ever fail, that's a huge indication that something has changed and it's manual intervention. Because algorithmically, the price is going to respect these types of things. But if they stop, the hands in the mix. The people that are going to push price beyond where you think they're going to go, even my stuff, even me taking a trade, it's not going to work. They're just going to upset it. And that's okay. I can accept that. The problem is, can you? Can you accept an uncertainty of when that's going to occur? I got things that I can see when they get involved in it, but not always. But when I see things like a balanced price range give way, then there's something underlyingly behind the scenes that I don't know what they're doing, but I know now they're in it. Remember the analogy I gave you when Neo and he sees that black cat walk and then he looks over and sees it again and he says, well, that's weird. That's deja vu. I just saw the same cat twice. And they all knew because of experience, shit's changing. We got to go. The agents are on our way or on their way. There's a change in the matrix. They made a change. That's manual intervention. The same thing when I'm watching price visually and I see things like a balanced price range break. What I think was underway is changed. It's not likely to occur. Here, that's not the case. We're seeing this candle's high, that candle's low because it's moved back and forth. In that range, we're not concerned about price going below that. We're seeing it deliver up, down, up. You see it? That's the balanced price range here on the 15-second chart. But visually, it's this. This candle's high, that candle's low. But that it's occurring right there. Did that candlestick go below that low right there? No, it didn't. So what's changed? Nothing. Everything's still valid. That's why I was telling you. I believe we're going to go down to this little area here in the inefficiency on the 1 minute chart, but not go below this area here because this is a balanced price range. This range high, that range low. The market rallies back up, finds some support at the new week opening, got low again. And then here, and I was telling you, watch. Look what it's doing here. See how it's finding support right at the middle of the opening range gap? That's what this is, the opening range gap. And the market rallies up, comes back down, small little retracement. This is the old relative equal high, which is now, as it retraces, is what? It is a discount array. Old highs are the highest discount array. Old lows are the lowest premium array. So if you have a reference of where the market's going to draw to, up or down, every time you breach a PD array, you got to look back at the range it just traveled through and map out each PD array. Did you miss a PD array not being traded to? Did it totally disregard it? That's a good thing. That means you're on side. All those things are indicative that you're on the right side of the marketplace. And the market trades back down in relative equal lows, sweeps it, doesn't touch the new week opening gap here. And now we're just meandering around. Breaks down. Where's the trade back into new week opening gap high? What time of day is this? We're in lunch. So what can the lunch time do? Retrace on what's been profitable. So it's going to seek the sell stops on moves that's been going up, or it's going to seek the buy stops on moves that's been going lower. Look at the reaction off of that and where we're at here. If you don't extend the new week opening gaps on your chart and keep them on there for a few weeks, you're trading blind. You have no idea why the market's doing what it's doing. A Reaper fair value gap. Just because I introduced it, don't think you know it. Don't think because I showed my deuce, you think you know everything, okay? There are certain little things that change in price that make it one thing or the other. Every fair value gap is not the same. If they share the same space of another PD array, it changes its character. It makes it something else. But that is a Reaper fair value gap that I showed the other day, and I told you to project it through, extend it through, and how many times it used it. Key takeaway, what is August 1st, first day of the week? What time did that gap get referenced? It happens every single month because the algorithm will go back to a specific date. What date would it use? First trading day, first day of week, Wednesday, previous Friday. That's not all of them. Let's go back to the first day of August. Use the first pertinent PD array of August. Carry it through your chart, and you're going to see shit that you never saw before. That's all I'm going to tell you now. A Reaper is a scythe. It literally cuts through the whole fucking month and makes it so tradable where any opportunity you see where you can engage that one, and as long as it matches time of day when the market should deliver, it's just obvious. This is a real easy. That's one of those times when you ask me, how do you know which fair value gap to use? Well, that's one of them because it has to be anchored to a specific day that is meaningful. First day of month, first day of week. What's the first fair value gap that forms after 9:30 on a Monday? Draw that bitch out through the time over the course of your week and the month.